picture this. You have, completely mastered the charts. You know your entries flawlessly,
Oh, yeah.
right? You completely understand market structure, where the trends are shifting. You have a really solid grasp on support and resistance levels,
Hmm.
and you are like fully dialed into the smart money concepts, tracking exactly where the big institutions are placing their capital. You've done the studying.
You've put in the hours.
Exactly. But despite all of that pristine technical knowledge, your account just keeps bleeding. You watch your hard-earned balance slowly or maybe rapidly just drain away.
It is a really devastating reality for so many people who dive into the markets.
It really is.
They put in thousands of hours of homework and, back testing and charting, but the financial results just completely fail to reflect that intense effort.
And that brings us to the core revelation of our deep dive today. We're pulling insights from some foundational material on trading psychology, specifically the disciplined trader.
Okay.
It is. And the massive unavoidable truth we are exploring today is this: the problem isn't your strategy. The flaw isn't in your charts. The flaw is, well, it's in your brain.
Which is a profound and frankly very uncomfortable shift in perspective.
Oh, totally uncomfortable.
Because most people naturally assume that if they are losing money, there must be like a mathematical flaw in their technical analysis.
Right, like they missed a line on the chart.
Exactly. But when you look at the underlying psychology of the markets, it becomes unequivocally clear that trading is far less of a chart game and far more of a mental game.
Our mission today is to figure out why that is. We are going to master two massive mental shifts. First, we're going deep into how to ruthlessly manage loss anxiety, the sheer panic of losing money.
Essential.
Right. And second, how to completely rewire your brain for long-term statistical thinking. Okay, let's unpack this. Before we can even begin to fix the anxiety of losing, we have to look at how we are actively sabotaging the technical knowledge we already have.
Right, because traders generally aren't losing because they don't know how to identify a good setup.
Right.
They lose because they simply cannot control their own impulses in the heat of the moment. I mean, if you look at the behavior of a struggling trader, you see a recurring pattern of really highly emotional reactions.
Oh, for sure. Like what?
Well, they enter the market way too early out of a fear of missing out on a big move. Then, conversely, they close winning trades far too fast because they are, absolutely terrified of losing a tiny bit of floating profit.
Yeah, that makes sense.
They engage in revenge trading after a loss, they emotionally double their lot sizes to make money back quickly, and they completely abandon the strict rules they set for themselves just like hours prior.
I was actually thinking about this, and it feels exactly like comparing a great trading strategy to owning a high-performance sports car.
Oh, I like that.
Yeah, like you can have the most flawlessly engineered million-dollar engine under the hood. That is your technical strategy.
Right, the engine is perfect.
Exactly.
Yeah.
But it absolutely does not matter how perfect that engine is or how aerodynamic the chassis is if the driver, which is your mind, panics and aggressively jerks the steering wheel every single time the tires hit a minor bump in the road.
You're going to crash.
You're going to crash that car straight into a wall, regardless of the horsepower.
That analogy perfectly captures the dynamic between strategy and execution. And to understand the why behind that driver panicking, we have to look at how the average retail trader views a single losing trade.
Yeah.
When that driver hits a bump, which in trading is hitting a stop loss, they take it immensely personally.
Oh, yeah, it hurts.
It does. They become highly emotional because they are operating under this deeply ingrained yet entirely false belief that every single trade must win to validate their intelligence.
But a losing trade doesn't make you a bad trader, right? Like, doesn't mean your sports car is broken.
Not at all.
It just means the probability didn't favor you on that one specific, isolated occasion.
Exactly. But bridging the gap between knowing that logically and feeling that emotionally, well, that's the hard part. Look at some of the most legendary figures in finance.
Like who?
Like billionaire hedge fund managers, Paul Tudor Jones or Ray Dalio. They take massive losses. In fact, they take losses constantly. It's just an unavoidable part of the business.
So what makes them different from the guy sitting at home, like sweating through his shirt over a $50 loss?
The difference is entirely in their mental framework. The professionals do not internalize a loss as a reflection of their self-worth or their intelligence or their overall
Why,
competence.
it's not a personal attack.
Exactly. They view it merely as a statistical reality, a business expense. Retail traders, lacking that protective framework, well, they let one single stop loss completely destroy their emotional equilibrium.
Which brings us to the first major mental shift we need to make today, managing that loss anxiety. Because taking losses personally leads to immediate panic, we have to put strict physical guardrails around our money.
Crucial step.
Yeah, we have to protect ourselves from our own anxiety before it even has a chance to ignite. Looking at the data on this, one of the most effective guardrails is shockingly simple. It's risking only 1% of your total account capital per trade.
Mm-hmm.
I love this concept because it completely attacks a huge myth in the trading community. People always complain, oh, my psychology is just weak, I need better discipline. But what if your psychology isn't weak at all? What if your position size is just, way too big?
It is a critical distinction that completely reframes the problem. Oversized positions create physiological breakdowns.
Wow, physiological.
Yeah. If hitting one stop loss ruins your entire mood for the day, if it makes your heart race, it is a mathematical indicator that your financial exposure is simply larger than your current emotional capacity to handle it.
This is so true.
The formula is very straightforward. Small risk equals a calm mind. Big risk equals an emotional disaster.
It's like trying to solve a complex Sudoku puzzle while someone is dangling your physical wallet over a roaring campfire.
That's a great image.
Right. Of course you're going to panic. Your brain isn't focused on the puzzle, it's focused on the fire. So, step one is obvious, reduce the position size to put the fire out.
Exactly.
But even with a 1% risk, a string of losses can still hurt. So if downsizing your position is step one, step two has to be knowing when to completely walk away.
Yes, the hard stop.
Yeah, the literature suggests setting a non-negotiable daily loss limit. For example, if you lose 2 trades in a row, or you hit a maximum 3% drawdown for the day, you stop, period. Close the laptop.
And the biological mechanism behind why that daily limit is so essential is just fascinating.
Oh, tell me about that.
After taking consecutive financial losses, your brain undergoes a very real physical and chemical shift. You aren't just upset. The amygdala, which is the fear center of your brain, essentially hijacks your prefrontal cortex, which is the area responsible for logical, analytical thinking.
Wow.
Yeah, your brain drops directly into survival mode.
So your body literally thinks it's being chased by a predator.
Quite literally, yes. The primitive parts of our brain cannot distinguish between the physical threat of a predator and the financial threat of losing our resources.
That's wild.
When your brain is in survival mode, it feels acutely under threat, and it floods your system with cortisol and adrenaline.
So you're just running on pure stress juice.
Pretty much. And this creates an overwhelming, completely irrational urge to launch emotional recovery missions to win back the lost resources immediately. That is the exact moment discipline evaporates. Sometimes the absolute best, most profitable trade you can make on a given day is simply shutting the laptop and walking away.
Which perfectly sets up the conversation around revenge trading, the urge to jump right back in and fight the market.
A classic trap.
The advice here is pretty brutal. Trading to recover right now means you are no longer trading a high probability setup. You are trading anger.
Yes.
And angry money always disappears. The rule of thumb I keep seeing is that you must walk away for exactly 15 minutes. Stand up, drink water, leave the screen. But I have to push back on this a little bit.
Okay, let's hear it.
Wait, if I'm on a losing streak, but I am looking at the charts, and I can clearly see the market is still moving, it's highly volatile, and it's offering new opportunities, isn't it perfectly logical to want to stay at the screen and execute a new trade to break even? Why is walking away for exactly 15 minutes so crucial? Can't I just take a deep breath at my desk?
This raises an important question, and the answer goes right back to that survival mode we just discussed. If you stay at the screen, every single tick of the chart, every flashing red or green candle continues to feed that threat response in your nervous system.
Like staring at the tiger that just bit you.
Precisely. You might convince yourself that you are analyzing the market logically, but your hijacked brain is actually just scanning for any possible excuse to execute a trade and relieve your internal anxiety.
That makes a lot of sense.
It is the financial equivalent of road rage. If someone cuts you off in traffic, taking a deep breath while still staring at their bumper doesn't stop you from being furious.
Definitely not.
The 15-minute physical reset, actually standing up, walking to another room, drinking water, it's biologically necessary to extinguish that emotional fire. It takes time for those stress chemicals, the cortisol and adrenaline, to physically dissipate from your bloodstream.
So it's literally a waiting game for your blood.
Yes, you have to break the visual loop so your prefrontal cortex can come back online. You fundamentally cannot fight biology with pure willpower while staring directly at the trigger.
Okay, that makes total sense. I never thought about it as literally waiting for chemicals to flush out of your system. You're
Yeah.
basically putting yourself in a timeout to let your nervous system reboot.
Exactly.
I can only imagine staring at a blank wall in my kitchen for 15 minutes while knowing the market is moving. Feels like absolute torture, though.
Oh, it does feel like torture at first, but that boredom is scientifically necessary. It proves you are stepping out of the dopamine-driven frenzy of the charts.
All right, so let's map this out. You've built these guardrails.
Mm.
You've lowered your risk to 1% so you aren't sweating. You have a hard daily loss limit. You physically step away to avoid revenge trading.
Right.
But what do you actually focus your mind on instead? If you aren't supposed to be obsessing over winning your money back, where does your attention go?
You must anchor your mind to the process rather than the fluctuating money. Staring at your floating profits and floating losses every single second is a recipe for emotional exhaustion.
It sounds exhausting.
It makes your emotions dance on a string. Fear tells you to close the trade immediately to secure a tiny win. Greed tells you to hold out for just a few more dollars. Hope tells you to hold on to a completely losing trade because maybe, just maybe, it will miraculously reverse.
A hopium. It's deadly.
It truly is. This is exactly why professionals shift their entire paradigm. They don't finish a session and ask themselves, how much money did I make today?
Right.
Instead, the daily question becomes, did I follow my model perfectly?
Because when the process improves, the profits just naturally follow as a byproduct.
Exactly.
Obsessing over the money creates instability, but obsessing over the execution creates consistency. But, execution implies you actually have a plan to execute,
Which is key.
which means amateur traders trade their opinions and feelings, while professional traders only trade plans. You have to define absolutely everything before the opening bell even rings. What specific setup you are looking for, the exact entry price, where the stop loss goes, where you take profit, and your maximum risk.
Because if those parameters are not clearly defined before you enter the trade, I guarantee your emotions will define them for you during the trade.
And that's bad news.
Very bad. Emotions are terrible decision makers in a high-stakes environment. Your trading plan must be fundamentally stronger than your feelings.
So, practically speaking, if I'm waking up, I've got my coffee, and I'm staring at the charts, how do I actively stop my emotions before I even click buy?
This is where building a pre-trade mental routine becomes invaluable. Think of like a 3-minute ritual.
Okay, 3 minutes.
Before you even unlock your trading platform, you take 3 deep, regulated breaths to slow your heart rate. You physically read your trading rules out loud. You check the economic news calendar so you aren't surprised by sudden volatility.
Right, no psoriasis.
And you actually visualize yourself executing with discipline, even if the trade goes against you.
So what does this all mean? When I look at the pre-trade routine, the non-negotiable plan, the fact that you might just sit there waiting for hours because, as the saying goes, no setup is also a setup.
Right.
It's exactly like a professional athlete in the locker room. You are warming up, stretching, and memorizing the playbook before you even step onto the field.
I love that comparison.
Yeah. You absolutely cannot figure out the rules of the game while you are sprinting full speed down the turf with massive 250-pound linebackers running directly at you.
Yeah.
You have to know the play before the ball is snapped.
What's fascinating here is how the most elite traders ensure they're actually sticking to that playbook. They don't just rely on memory. They use a daily psychology journal. And I don't just mean a spreadsheet of wins and losses.
Let's dig into that. What are they actually writing down? Because journaling sounds a bit, a bit like a diary. How does writing things down actually make you a better trader?
It bypasses the emotional center of the brain and forces radical accountability. In a psychology journal, a trader writes down exactly why they entered.
Okay.
They write down the specific emotions they felt while the trade was active, like my palms were sweating, or I felt bored so I clicked buy, or I moved my stop loss further away because I was hoping it would bounce back.
Wow, getting really honest.
You have to, because you simply cannot fix a problem that you refuse to track.
Wow, so it forces you to confront the man in the mirror. You physically write down, I entered early because I was bored and wanted action, and suddenly the problem is completely undeniable. You can't blame the market algorithm for that.
Precisely. The journal acts as an unforgiving mirror. It exposes the harsh truth that a trader's biggest, most devastating financial losses almost always come from their own hidden, repeated patterns of self-sabotage, not from some fundamental flaw in their chart analysis.
That's a tough pill to swallow.
It is. The act of writing it down engages the prefrontal cortex, the logic center, and forces you to objectively analyze your subjective feeling.
It's brilliant. So,
Yeah.
by stripping away the acute anxiety of daily losses with strict 1% risk limits, utilizing the 15-minute timeout to metabolize cortisol, and ruthlessly focusing on execution through detailed journaling, well, the trader is finally ready for the ultimate mental evolution,
The big leap.
getting to the absolute pinnacle of trading psychology, which is seeing the market through the lens of long-term probabilities.
This is the ultimate goal. Professional traders think in a long-term series, not in single, isolated trades. As we established earlier, one single trade outcome means absolutely nothing. It is a random blip, but 20 trades. A series of 20 trades tells the undeniable truth about your strategy's effectiveness.
It's the shift from thinking like a gambler to thinking like a casino.
Exactly. Think about a casino floor, specifically a roulette table. The casino management does not break into a cold sweat and start panicking when one customer hits a huge jackpot on black.
No, they just bring them a free drink.
Right. They don't run over and unplug the machine or change the rules of the game. They don't sweat it because they know the mathematical edge is built into the green 0 and double 0 on the wheel. They know that edge pays out consistently over tens of thousands of spins.
An emotional retail trader worships every single candle on the chart like it's life or death.
Yeah.
But a disciplined trader trusts statistics and long-term execution.
It requires the ultimate detachment from short-term outcomes. The casino mindset requires you to fully accept that individual wins and losses are completely random.
Completely random.
Yes. You cannot predict the outcome of any single spin of the roulette wheel or any single tick of a stock. But if your trading system has a mathematically proven edge, the overall positive result over time is practically guaranteed.
Here's where it gets really interesting, though. I hear this analogy all the time, but let's play devil's advocate.
Yeah.
It is incredibly easy to just say, think like a casino. But a casino literally owns the game. They have built-in absolute mathematical certainty programmed into the software and the physical roulette wheels.
That's true.
So how does a retail trader sitting at their desk at home actually build that level of ironclad trust in their edge over a series of 20 trades without completely panicking, losing faith, and changing their entire strategy at losing trade number 4?
If we connect this to the bigger picture of everything we've unpacked today, the answer to that actually becomes very clear. For a retail trader, the edge isn't a rigged roulette wheel. The edge is precisely that rigorously back-tested chart setup combined with the non-negotiable mental plan we detailed earlier. How do you build trust in it? By utilizing your psychology journal and tracking your execution relentlessly.
So the trust doesn't come from a magical belief. It comes from the data you've collected on your own behavior.
Exactly. If you panic and abandon your strategy at trade number 4, it means you are still worshiping individual Campbells. You are still viewing a single financial loss as a personal failure and a physical threat, rather than recognizing it as a completely random statistical event within your proven series.
Wow, yeah.
The casino mindset demands that you trust the math of your own historical backtesting, and more importantly, that you accept the random distribution of wins and losses. Consistent, robotic execution of your proven setup is the only way to guarantee that the probability actually works in your favor over time.
It all clicks together perfectly. It's a massive chain reaction. If you are risking too much, say 5% a trade, your amygdala fires off, and you inevitably panic at losing trade number 4.
You're doomed from the start.
Exactly. If you don't have a pre-trade plan, you don't even know what your mathematical edge is in the first place. But if you keep the risk at a boring 1%, follow the rules of your playbook, take your 15-minute timeouts when you get frustrated, and log your emotional state in your journal, well, you can actually sit back, you can breathe, and let the series of 20 trades play out calmly.
Because the individual techniques we discussed are not just isolated tips, they form a comprehensive, interconnected psychological framework.
Yeah, a real system.
And that framework is specifically designed to override our very flawed, very emotional human nature.
And that framework is exactly what our deep dive today has aimed to illuminate. To summarize the core message from this exploration, the market is not defeating your strategy. Most of the time, through impatience, fear, and ego, you are defeating yourself.
Perfectly said.
The ultimate takeaway here is that the exact day You finally learn to control your own mind, your impulses, and your biology. That is the day you start controlling your money. And that is the day you transition from being a gambler throwing darts to being a real professional trader.
It requires a profound, almost uncomfortable level of self-awareness and discipline, recognizing your own emotional triggers, understanding the biological reality of survival mode in your brain, and actively implementing those physical guardrails like daily loss limits and pre-trade routines. These are non-negotiable steps toward achieving any sort of consistency in the markets.
You are walking away from this deep dive today with a very clear, actionable blueprint.
Mhm.
You now have the specific rules for managing loss anxiety, strictly capping your risk so your brain doesn't sense a threat, physically walking away for 15 minutes to literally let the stress chemicals flush out of your system, and cutting off the trading day entirely when you hit your limit.
Crucial tools.
And you also have the blueprint for long-term statistical thinking, detaching from the floating money, acting like a casino floor manager, and trusting the math over a series of 20 trades, rather than obsessing over the outcome of one.
The tools themselves are incredibly practical and simple to understand. The true challenge, of course, is the daily, relentless, boring application of those tools when the market is actively flashing red and trying to provoke an emotional response from you.
It is the ultimate test of human discipline. And as we wrap up this deep dive into the fascinating mind of the disciplined trader, I want to leave you with one final, slightly provocative thought to mull over on your own time.
Mm.
We have established today that your financial success in trading is almost entirely dependent on how well you can emotionally regulate yourself during moments of sudden financial loss, uncertainty, and stress. So what does your current trading track record actually reveal about your emotional maturity, your patience, and your impulsive behaviors in your everyday life outside of the markets?